All right, ladies and gentlemen, welcome back to my $2.1 million challenge across 6 different prop firms. This is episode 4. We are sitting currently in 2 trades on the USD Swiss franc short and the add-on on the USD Swiss franc. All trades called live before it happened here on YouTube. It's been a while since I did an update on this challenge documentary. Why? You should know from my Instagram that I'm currently on that world podcast tour. Just came back from Miami last night. And by the way, since I want to do everything here for that challenge live in front of your eyes and call all trades before they happen, so for you to see how my process works and to be fully transparent. That's why it takes a little bit longer, because I'm traveling a lot right now. And for me, this challenge, that $2.1 million challenge, is like a case study. I want to showcase that these challenges can be done with a very busy lifestyle, with a set and forget approach, higher time frame trading approach, where you basically just have to set these trades and forget them and let them run. And by the way, all of you, not all of you, but some of you are asking for constant updates on these trades. This is not how this works. If you don't know how to manage these trades by yourself, you should not trade at all. But I will keep that rant for later once we go into the USD Swiss franc updates. But for now, what we're gonna do is I'll have a new trade for you that might trigger tomorrow, on Monday or Tuesday, hopefully. So it's on the precious metals, it's on silver, and afterwards we're gonna go in a quick USD Swiss franc update. But first, let's talk about silver, my 2-step mechanical process, fundamentals, technicals, and how we could potentially get into that trade and what I expect from silver. So let's get into the charts. Now, first things first, we start with our CUT report on silver. And I want to first show you, so we have here the red are the retailers, the yellow, the fund managers, orange, yellow, and the blue one, the smart money, the commercials here. But I just want to show you the raw data, and I want to show you the retailers here. They're extremely bullish compared to their previous behavior. How bullish? We will look at my proprietary index in a second, and I'll show you how bullish they actually are. But you see already that they're very bullish compared to their previous behavior. And if you look at the smart money, the commercials, here the producers, we see the blue line here down here. They're very bearish compared to their previous behavior. How bearish? I'm gonna show you in my index in a second. So if I minimize this chart on the CUT, by the way, that's the silver futures charts. Here, this is not just at SI, which would be the adjusted chart, which you might know from the futures. No, this is really important here because we are talking about an unadjusted continuous chart, 120 XN plus HK and S.E.T. What this means, we could cover in another video, but this is a futures unadjusted continuous chart, which is really relevant for you to understand if you analyze futures on higher time frames as well. If you want to know what that means and how to get to these unadjusted continuous charts, let me know in the comments below. But this video is purely to showcase or to show you basically what trade I want to take next week. So we saw already the retailers are extremely bullish and the commercials, the smart money, are extremely bearish compared to their previous behavior. Now, how bullish and how bearish, that's what we're gonna see on my index. And we have here, the red line here represents the retailers, the blue line represents the smart money, the commercial. So let's call it the dumb money and the smart money here. We know we have to trade against the retailers. By now you should know that. So what are we going to see here? So we see here they're up here, which means they're in extreme. They're above the green horizontal line, which means they're in extreme. And the blue line, the smart money, is below the red horizontal line, which means they're also in extreme. What I can do here, I show you in the settings quickly. You see here, weeks, look back. How many weeks I can look back in relation how bearish they are. So see here, I'm looking back 104 weeks. What does this mean? So trading year has 52 weeks. So if I put here 52, I would look, hey, how bearish are they in relation to 1 year? And if I just put here 1 year, I want to show you here, they're up here as well, so they are extremely bearish, the most bearish in 1 year. And if I put here 104, which is basically then 2 years, I see here they're also up here, and the retailers are up here, and the smart money is down here, so they're basically what you see here, they're in 2-year extreme, ladies and gentlemen. The retailers are the most bullish in the past 2 years, and the smart money is the most bearish in the past 2 years. And if I go here to even further 3, that's the maximum that I look at. If we were in a 3-year extreme, then this would mean a very, very big move. And guess what? Look at this. The retailers haven't been that bullish in the past 3 years. Can you imagine? And it gets even better. The smart money hasn't been that bearish in the past 3 years as well. You see, they're on the opposite side. So what it means is we can expect a big move to the downside. Now, is that move gonna happen tomorrow, day after tomorrow, this week? No, right? This can also take some time. That's why it's not a timing tool. That's why we need technicals to time the market. But it gives us a clear bias that this market is going to turn. And the market is going to turn. This is like for certain. The market is going to turn. But we can still be wrong because the market timing can be wrong, all right? But that the market here, since we are in an extreme, in a 3-year extreme, this means the market is going to turn. This is 100% certain, ladies and gentlemen. But when? This is written on a different paper, right? That's why we need to time the market with technicals. But let's go back, and I just want to quickly show you, again, on 2 years. It's also interesting what happens if the market is in that 2-year extreme that we saw here, for instance. We saw that the retailers getting into an extreme, and the smart money was not even fully in extreme, and we got this big red move here. Look here, they were close, but the smart money was not. So we want to see basically an area really, and this hardly happens again. That's why it's going to be such a nice move where we have both of them in an extreme, where the retailers are in a bullish extreme and the smart money is in a bearish extreme. We hardly have that. Look at that, for instance, here. The smart money close to an extreme, but the retailers in that extreme, we see that touching that green line, and we see that drop here, right? Here almost touching the green line, almost in that extreme. So you see it's very, very rare that we get this extreme here, but it took a while. But by the way, look at this one. This was, can you remember 2020, right? I don't have to mention what happened in 2020, right? This is when the retailers were in extreme. So you can tell, well, if we get a crash, right? This is basically, there is no such thing as a black swan event, because we can anticipate these crashes based on the smart money and retail behavior. We see it here, we see it here, but this is a 2-year extreme. Now, we could look at something that maybe I can showcase you on a 1-year extreme. 52, what happens in a 1-year extreme? So now you see here basically, you see the market is going to drop, where you have the smart money bearish, the retailers bullish. You have a similar situation here and here basically. You see that here as well, where you have them on the opposite side, here as well, here as well. You see that what happens when they are on the opposite side. And by the way, the same thing obviously is happening when you have, but we're not going to be bullish on silver, but the same happens when eventually you have the smart money bullish and the retailers bearish, so the other opposite side, then you get a nice rally. But here now we clearly see that, hey, retailers are extremely bullish, 3-year extreme, even the smart money is in a 3-year extreme bearish, so I expect this market to drop. But this is only one of the tools. Now let's look at our seasonal forecasting tool. All right, and what we see is basically, if I put a vertical line here, is that from tomorrow, you see basically it's the next few days, it's a little bit flat, but then we drop basically into the whole month. You see, this is a 15 years, you see, 15 years forecast. So looking at 15 years historical data, and then we are projecting here, we are basically, now this way maybe better. So see, this is what our tool then projects, basically a drop here on silver for the next, well, almost 4 weeks, almost starting from tomorrow. You see, it might be a little bit choppy in the next few days, but then eventually we're going to go down. But maybe we can position ourselves already on Monday or Tuesday if price comes back up. We're not just shorting blindly. And so we have 2 out of 3 rules met. The last one I want to show you, well, the third rule is basically valuation. And here we are looking at something really special. So we want to see basically only valuation versus gold. So gold-silver relationship is really important. So I want to see how are we valuated versus gold. So now I remove here quickly the treasury bonds, and I don't necessarily care about the dollar. And this is long-term valuation, ladies and gentlemen. And this is long-term valuation. Here, what you see is basically, if we do some back test here, so this is now silver chart up here, and down here, the valuation model versus gold. And what we basically see is, if we do also here back testing versus gold, look at this, overvalued versus gold, overvalued versus gold, overvalued versus gold, overvalued versus gold. We're starting here, it takes a little bit of time, but then dropping. Overvalued versus gold, overvalued versus gold, overvalued versus gold, overvalued versus gold, overvalued versus gold. And now we are overvalued versus gold again. We could do this all day long. So what this tells you is, hey, once we are overvalued versus gold, then we need to short silver. So as you see, fundamentally, this is an all-stars aligned trade. Can an all-stars aligned trade still fail? Absolutely. It's just probability, so never bet your house on it. That's like really important. But again, it gives us a lot of probability. All 3 rules met. It's an all-stars aligned trade. CUT, retailers, super bullish. Actually, in a 3 years extreme. We have the smart money bearish, also in a 3 years extreme. We have seasonality in our favor for the next 4 weeks. And we are overvalued versus gold, ladies and gentlemen. So fundamentally, this is a really good trade. So now, how are we going to time this trade? Now we're going to use technicals. Now, first of all, let's look where price is basically coming from on a monthly chart. On a monthly chart, so price, you see, this was the top. And we have here, so price is already, you see that, we have here a clear drop, base drop, actually also kind of a level on top of level scenario. What we had here, you see drop, base drop followed by a drop, base drop, again level on top of level. This is an overlapping level on top of level scenario. We hit the distal level, we discussed that as well on the USD Swiss franc. So we we hit already that one. So we are coming from higher time frame supply. So that's already great. Now, if we look at the weekly chart, let's use here the weekly as well. And let's check if we are also covered by weekly. Again, big brother, small brother principle. We ideally, again, technically to have all stars aligned, a daily is covered by the weekly and weekly is covered by the monthly. This is what I call a big brother, small brother principle. Now, you see here also, well, it's basically coming from that picture perfect. Look at this. So weekly also, we are coming from that really nice chop-based chop here. Amazing weekly supply, so that's also nice. Plus what we see here, we have now technically, price action-wise, a shooting star. Another add-on, right? Technically, we have like a reversal candle here on the weekly. Now, it's already technically looking really good. Now, how do we get? Could we just short below that weekly shooting star? Yes, we could, but I don't want to chase price here. So what I want to do is here, I want to just wait for a little retracement higher and then basically get into that trade. Now here I have the 960 minute. I like actually, I like 2 time frames besides the daily, or actually 3. I like 960, 720, and 240. And you see basically already here you have that nice chop-based chop sitting here. Let me now quickly go on a 240 and confirm this as well. 240 obviously is the 4-hour chart. While it's loading, I don't want to waste your time as well. We can look at the daily quickly on top because we saw that on a 960, but most likely what we are going to do here is the following. We're going to take a little bit of because on that 960 we basically saw that the level starts already quite early. I'm not sure if we have to take that whole thing here. That's really the question. I would tend to, let me remove these lines here quickly, the seasonality lines, because we see here starting the level on that wick over wick on that daily. You see the wick over wick. So the wick over wick here, the wick over wick, the 2 candles, previous candles. This is basically the 960 level, a little bit refined here. And we have here a level on top of level, so to speak, again. And then we would just need the stop loss in a way that is higher up here. So let me now do this with one single, so we can also put a risk to reward here. Now 1 to 1, 2 to 1, 3 to 1, just pointing out all of these. We do them all nice and blue, so we get the targets here in a blue line. All right, so that's, oh wait, why is that here too? Oh, sorry, the 1 to 1 is here. All right, 1 to 1, 2 to 1, 3 to 1. We don't need a 4 to 1 here on this trade because we're doing a challenge, right? It's not, we're doing a challenge here. We are not here for risk to reward. We are here for passing the challenge. So I would argue that's the best. So because we are close to the highs, close to the pivot, so we put our stop loss above the pivot to be perfectly protected. By the way, just quickly, you see here on a 240-minute chart, there is basically the level itself starts at, on a 240-minute, you could basically get even higher, right? But again, it's always a matter of likelihood getting filled versus probability of likelihood, probability of getting filled versus risk to reward proposition. It's always like this trade-off that you have. For me, it's here, and you see here, basically, I'm planning to go short a little bit lower already. Why? For me, it's not about risk to reward proposition. It's about a little bit FOMO to get into this trade, because I would not expect price to go really deep into that daily level on top of level. I would expect a slight touch, maybe go, if we go deep, then it is what it is. But again, there's not much difference between entry at 31 31,300 versus almost 31,200. So yeah, so I think that is a nice compromise here on that daily, because you saw that 960 actually wider version that we just showed in the very beginning starts somewhere here. So it's a compromise between actually 960 entry and 240 entry. So we cover the pivots. We cover the pivots here as well. Be covered by the secured by the pivot. So stop loss obviously above the pivot. So that would be a 1-to-1. That would be a 1-to-1. That would be a 1-to-1, and this would be a 2-to-1, 3-to-1, and so forth. How far we take it? We take it basically until we pass the challenge, because right now we have the USD Swiss franc, 2 trades running. This one, in an ideal scenario with these 3 trades, we could potentially pass the challenge. So we don't need any more trades here. So now that's the silver trade. So that's for tomorrow. Now update on the Swiss franc. Guys, both trades are running. And so many of you are asking for updates. Guys, if you're not used to swing trading, if you don't know how to manage these trades, if you feeling pressure, if you have too much capital at risk, or if you're over leveraging yourself, that's completely on you. Don't expect me to give an update when there's no update needed. I'm doing this since more than 10 years. I know what I'm doing, ladies and gentlemen. So for me, it's set and forget it and let these trades run. The market will do its thing just all the time, not by me giving updates. This will not giving you any relief. This will not make any difference. Let the market do its thing, and the position will play out anyway. All right? So guys, chill out and let the markets do its thing. Really. Like, it's sometimes if you don't understand how to manage these trades, then better don't trade. Really. So that was my rant. I hope you understood. Now, just to show you, I'm having this one example here on my MoneyVis account. Here is it's a 500K challenge, but they copy everything in the back end. So it's a 200K. You see that here. You see here I don't have a swap. It's a swap-free account. So you see, like, basically I'm 5% in profit on, you see, and as we talked about, these two USD Swiss franc initial add-on, exactly as we discussed, right? Now, the way is now, and I'll show you on an Excel file how I did that here, how I'm dealing with these firms, because these firms, you see, have different, basically, challenge targets. And then some of them are basically, as I just showed you, swap free. Others have swaps, so I'm less in profits. So I need to manage them differently. You see, MoneyVis, I only need like 2% more, and I passed that one with these single USD Swiss franc trade by itself. Other ones like Thunder Pro, where I have a 10% profit target and I have swap on top, I need obviously I need a bigger movement, and I need the help of maybe another trade as well. So you see basically the way how or Indigo, I only have apparently 6% profit target. Wow, nice. I could maybe just do it with the USD Swiss franc trade as well. And by the way, again, it's always 2% risk per trade. So you see basically different conditions, different profit targets. So I need to individually always check, did I pass it? Do we need another trade? What's going on? I have to check individually here. And basically I have different platforms as well to look at. And yeah, so just quickly, just to be here fully transparent, guys. So we say here, drawings, text again, like always, 2% risk per trade, not more, and also not less on that silver one. But on the Swiss franc, just quickly to show you here as well. Let's go to the Swiss franc quickly. So, and just to show you quickly what I saw, retailers are getting again more bearish. Perfect, right? This is playing in our cards. So we would expect a move higher. Price is rising, but they're getting more bearish. Thank you, retailers. You're most likely gonna be wrong, and we expect a further movement. So just chill out. Stick to the trade. If you want to take profits, but don't ask me personally for advice. I cannot give 1,000 people personal advice what to do with their trades. So that's just not gonna work, especially not for free on social media. You have to understand that. All right, ladies and gentlemen, that's it. So fingers crossed for silver, first of all, that we get into the trade, and second of all, that the price is going to move in our favor again. Is prices going to go down on silver? Absolutely 100% certain. Is it going to happen tomorrow? Is it going to happen based on our zone? That's written on a different paper, because based on technicals, we can always be wrong. Market timing can always be wrong. Fundamentals can never be wrong. Fundamentals are going to play out eventually. Is it going to play out next week, the week after? We don't know, but they are going to play out. That's an important lesson. All right, guys, fingers crossed. Talk to you soon. Bye-bye.